we're seeing a lot of supply out there, but not a lot of people are moving here because that lock-in rate. If you live up in the north and you want to move to the south, there's some things that are impacting you. You're locked into a very low rate. You don't want to incur more expenses from insurance costs.
Welcome to Actualizing Success. In this podcast series, our in-house advisors discuss today's finance and technology topics with an emphasis on solutions that embrace tomorrow.
Today, I think it's time to talk about what we're seeing in the mortgage servicing business. So today we've got myself, Matt, as well as Kite, who's an industry veteran in that space, and within Actualize, pairs off against servicing and default, but also is in charge of our data and analytics. And so today we're going to talk a little bit about the mortgage servicing business and some things that we're seeing and talk about what's next in the market. So with that said, welcome, EJ, and I think we should get started. It's been, over 5 years since the pandemic started, and things have changed. So, what are some of the things that you've observed in that, EJ?
Yeah, well, thanks for having me, Matt. It's hard to believe 5 years has gone by. I mean, it's not really been as quick as I thought it would be, but that blip has caused some major changes, obviously, in our industry. And one of the key things, that we saw sort of coming out of the pandemic is, the supply and demand. There was not a lot of supply out there. Inventories were down, and what's interesting now is we're seeing those inventories come back up. And it's a regional thing for sure, but it has shifted to more of a buyer market in many regions, which for many of the folks that are going to listen to this, they have seen their home prices go up, and if they're looking to purchase, they've seen that as a major stumbling block. And in July, inventories were up 24% year over year, which is a nice lift, especially in the summer month. And because of that, we're seeing some of our days on market numbers go up, which is allowing, again, more options for buyers, a little bit more time to make decisions, where you might remember a couple of years ago, stuff was being listed and sold that day for 10, 15% above list price. Well, now we're seeing a little bit more time on the market. And I guess the most interesting thing for me is sellers this month have reported that they dropped prices on about 20% of their listings, which is going to help the affordability in some cases. But, as you're seeing probably in some of the news out there, that we're still seeing a very high median list price at almost $440,000. Consider back in 2000, what was the median list price was $160,000. So a little bit of easing of home prices, partly because of increased inventories, days on market. So list prices fell in, more than half, about 33 of the 50 largest metros. And 19 of 33 now are below peaks seen in 2022. So that's been good. And obviously the other key thing, we just saw interest rates. There's been a big whiplash from ultra low rates in 2021, where it was, 2.7, just shy of that, to that aggressive hockey stick rate hike to a max of almost 7.8. And now that we're in the mid sixes, it feels like it's a little bit more normal. So that's been the key things I've seen.
Yeah, I agree. I mean, I think one thing that you didn't mention during COVID at the beginning, there was an enormous amount of non-owner occupied purchases. In other words, investor property. That was really hurting supply. A lot of times investors don't even allow the properties to go on the MLS. It's just done investor to investor. And so that was something that I saw. I also very much have seen home prices coming down in terms of listings. So, and it's generally been one of two things that I've seen. In the highest demand areas, there are homes sell the day they're listed or put on the market or whatever it is. But in other areas where there is a lot more supply, I do see listing and then very quickly a drop in price. And then other times I've seen homes not sell and come off the market almost to cool off a little bit. But yeah, I've seen that stuff. And then I think, I'd be interested to hear a little bit more from you about what you're seeing in terms of uniformity across the nation, because the examples I'm looking at personally are in areas where I visit a lot and areas where I live. But what are you seeing in general, EJ?
Yeah, it's a great point. And the investor piece was something I saw in my previous job as well. At auction.com, there were a lot more non-occupied investor-owned properties. But across the country, it's mixed. And I know you're in the Northeast, you're in Northern Virginia, and I'm down in Texas, near Dallas. And regionally, the South and the West have seen the largest inventory gains. And I think it could be a mix of reasons there. I mean, people might be leaving their homes because of the insurance increases that we're seeing from weather impacted areas. But year over year, the Northeast, as an example, is only up 15%, where the West is up 32% and the South is up 25%. So the Northeast is still 50% or so below those pre-pandemic inventories that we've seen. So that's a supply and demand econ 101. I mean, that's the reason why prices are still going up. Now, the job market might impact it a little bit, as changes happen. If there's some, things going on in Northern Virginia, DC area, but, New York, places like that, we're still seeing just very low inventory levels, and those home prices, some of the analysis I'm doing for one of our clients, the Northeast continue to see record highs in home prices, but it's definitely starting to ease a little bit. Places like Vegas, Raleigh, even DC, 45% greater year-over-year growth. It's pretty big. So inventory seller price cuts are now leading to more sellers pulling their homes off the market. I said 20 some percent have taken them off. And like you said, Matt, we might dive into this a little bit later. I think they've pulled it off because it's a interesting time to sell. Summer months aren't always great. Usually it's a spring market. But days on market up 7% from a year ago and up 5% from the previous month. So, and just in my neighborhood, my local, take on it is I'm seeing a lot longer to sell here in this market. And there's a good chance that they're going to, pull them off the market, wait a while, maybe try to do it again next spring. So definitely interesting. The delisting growth, again, outpacing inventories. So we're seeing, which for every 100 loans that are new listed across the country, 21% or 21 previously listed homes were taken off the market. So to your point, I think there's going to be some changes there. So that's local. I'm seeing it. Some of the data we're seeing, the West and the South for sure has seen those inventories change quite a bit.
Yeah, not to tease you too much, but last I checked, Northern Virginia is not in the Northeast, EJ. But
no, I know. I think with that one, I'm in Texas.
I don't know what is it really is. I don't think we're mid-Atlantic either. I guess we're Southeast in Virginia at least. But anyways, I think we're on the same page on all of this stuff. But I would like to dig a little bit deeper into it and chat about, what really are the drivers of change. From what I've seen is that, it's really a whole lot of equity in a lot of homes, and you mentioned the 2.7 interest rate. There are a lot of people that are still sub 3.5. But what are you seeing in addition to all of that?
Well, some analysis I did a while back. I started looking at new construction and see if that impacted any of the inventories. And what we did see, there are certainly some areas, some regions with little to no new construction since the pandemic. So the New England, Great Lakes, they lag significantly behind their pre-pandemic levels. Markets like Austin, Denver, lots of new construction now have over 60% more active inventories compared to pre-2020. So there's certainly that. I think the construction is going to drive some of this, and I also think there's a bit of a population growth change. I think we all know people who during the pandemic were given opportunities to work from home, and in some cases permanently work from home, so they were given opportunities to move away. So population growth along with that sort of construction change has really been a regional impact as well. So in places like Florida, they've seen a large increase in listings, but there's also been a shift in population growth. So over 5% in some locations, they'll see more than 10% growth. So that's something that I think has been a driver is the population changes. In some places, they're up over 10% population growth since 2020, which is great. By contrast, Louisiana is demand depressed. Listings, prices, and population have all declined. And I think we might attribute that again to some weather impacts. In some cases, homeowners insurance has gone up so high that they're forced, or in some cases, insurance companies are leaving, and they're forced to get state-run insurance, which is high premiums and low coverage. The Northeast has a lot of locations that are price pressured, as you just talked about. So there's definitely some listing challenges up there. We mentioned earlier, prices still up. In some cases, I think the Northeast was up, I don't know, well over 540 now, where just a year ago it was, under $500,000. So big changes in the Northeast there. And then lastly, we see supply ahead of demand in locations like Texas, which is what I talked about before. Is I think we're seeing a lot of supply out there, but not a lot of people are moving here because that lock-in rate. If you live up in the north and you want to move to the south, there's some things that are impacting you. You're locked into a very low rate. You don't want to incur more expenses from insurance costs. So I think those are some of the things that I'm seeing.
Yeah. So remember back with COVID, I think, everybody was basically, shelter in place, stay at home, don't do much, don't travel so much. But a lot of people took the opportunity with the remote work to start migrating to different places. You'd mentioned Texas. I know Austin was a big destination for folks and they gave incentives, but also the big metro areas from LA north, maybe not as much the Bay Area, but certainly LA, Portland, Seattle. You saw migration to places like more rural Oregon, Eastern Washington, Idaho, Wyoming. I don't know if you have any facts on that or track to it, but it seems like those are really trendy. But at the same time, we're not seeing people migrate back to those metro areas. Do you have any thoughts on that?
Yeah, and some of the data I'm seeing, like you called it out, Marion County, Polk County, Florida, there's places in North Carolina, Santa Rosa County, Florida, they've seen really almost double-digit population change. And that's probably what you were talking about is we don't have the hard facts yet, but I'm guessing a lot of people were displaced somewhat during COVID and they were given a chance to move, and maybe they moved in with family down there. And then you go to the other side of the house where you look at, Lafayette, Parrish, Vermilion, places in Louisiana, Livingston, they're well below, they've had negative growth. So people have left there, which I think the standard, I don't know, what's the expected, there's 2 or 3% growth rate almost every year, it seems, in a lot of places, but that's been a problem. And where they've got no population growth, people aren't moving there, it's going to be a challenge to get those homes off the market. We're going to see a big, I wouldn't call it a housing crisis there per se, but I think those markets are going to suffer more than the Northeast for sure because of just the economies, everything else going on, and just that population growth is definitely causing some issues. And you mentioned the HELOCs. I'm interested to follow this now because the HELOC growth or lack thereof in some cases, people might be staying in place, especially that locked-in rate, and they're going to take out some lines of credit that could be causing us some default issues. If you remember back in 2007, 8, 6, people were taking money out, doing cash out refis and crazy things like that, eating away at that equity that was so high. And what we're seeing now is just rampant, rises in home prices. So your equity has got to be something that, like, even my own servicer reaches out probably once a month to say, hey, do you want to tap into your equity?
Well, so let's be fair on that. I think, when these big box servicer companies don't have a lot of new business on the fee side at origination, you got to make money somewhere. So I think part of it's also just a strategy to increase their revenue by offering the HELOCs. But I guess one thing that I wanted to touch on, both of us have been in the business since the 80s. We've seen the S&L crisis. We've seen regional depressed areas in the 90s with significant home price devaluation. We saw the dot-com bust. We saw the default crisis. And then all of a sudden, things got really pretty smooth in terms of everything. I just know that the market has amnesia, and it's like, come on, you can't forget the default crisis. But to your point about these HELOCs, I mean, it's almost like the behavior is something that you can't get out of your head in terms of greed and all of that. And so, what do you think about all of that?
Yeah, it's interesting being where I was back during the crisis, and what we're seeing today. The defaults are up. The seriously delinquent counts up very high, but foreclosures still really haven't hit. I was on a call yesterday, learning a little bit more about the FHA loss bit waterfall and how that's changing October 1st. It's going to be interesting. The credit mix from pre 2008. Fannie and Freddie took on more risk than FHA does now, and then after that, most of the default risk is flipped over to the FHA side of the house. But servicers, I think, like you said, greed. You mentioned that word. I think they're looking for solutions now to hopefully stave off any issues that they saw in 2008, if any of them are still around. And so they're going to have to use technology. One of the things that we do here at Actualize is, we look at ways to help our clients with predictive modeling. Flag early signs of borrower distress is going to be key. And there's a lot more data out there than there ever was before that sort of tracks spending behaviors, regional unemployment risk, whatever you think are the key drivers of that. And I think artificial intelligence is going to help with some fraud detection. It might even help with servicing optimization, because servicing can be expensive, especially if the credit crisis goes up. And I'll mention one last thing about the HELOCs. What I'm worried about is in markets where we do see a little depressed home prices, if they start dropping off, and let's say you originated a loan the last 2 or 3 years, you could potentially tap into the equity because it rises so much. But in 2 or 3 years, you might be in a situation where you're underwater, and that's going to be as a concern for servicers. I don't think it's going to be a full blown issue, but there's going to be some regional impacts for sure.
Yeah, I think the other things that I'm seeing are, just the cost of living in general is putting pressure. I saw a study about a month ago, I guess it's been, where we're seeing a lot of problems in credit card defaults in higher income brackets, which that's a leading indicator big time that there's some problems on the horizon. And I think, again, folks, even though they may have a lot of equity, for whatever reason, they're not tapping it. And I just think it just feels like we're getting ready to have a little bit more of a choppy market, not as stable waters as maybe in the past. And really, again, for folks listening, we do a lot of research on tech solutions in the market. And as much as EJ just talked about AI and such, when you look at the platforms that are out there for default, there's not a lot. I mean, there's some new companies that are emerging, but I just think the default at larger scale is going to be really hard for the market. And I don't predict the future, obviously, but clearly it does look like there's something coming. And so maybe we can explore that in one of our future podcasts, EJ, or maybe a white paper or whatever. I didn't know if you had any concluding thoughts or any messages that you thought were important for our listeners.
Yeah, I think when I'm talking to clients, I think they feel a concern coming. I think what you were just alluding to there, but they don't necessarily know where to look. And one of the things that I'm helping our clients with is to understand the challenges that could be coming, how to prepare for them, and the solutions and technology and the analytics can help ease some of that. What we had in 2008 lacks in comparison to what we have today in terms of information. And information is going to be key in the coming months and years, especially as we see sort of the markets changing, across the country at different paces. It's going to impact their portfolios in various ways, and they need to stay ahead of that.
I think that all makes sense. And we're coming to the end of our podcast today. And of course, If you want to talk more about any of the topics at all, you can find EJ and I on LinkedIn or through the Actualize website. We'd be happy to chat. And I think that wraps us for the day.
Thanks, Matt.
Thanks for joining us for today's episode of Actualizing Success. Make sure to visit us online at www.actualizeconsulting.com, where you can explore our service offerings. Don't forget to subscribe to the show on iTunes, Spotify, or your preferred platform. If you've enjoyed what we talked about today, please consider leaving a review and following us on LinkedIn. If you have any questions or would like to share your opinions with us, please send us a note at podcast@actualizeconsulting.com. We look forward to hearing from you.